Hi everyone, and thank you for joining us. I'm Sukanya Lal, and I'm Business Development Director at IQEQ in Singapore. IQEQ is a leading global investor services firm that provides comprehensive range of compliance, administration, asset and advisory services to fund managers, multinational companies, family offices, and private client groups operating worldwide. We are located in 23 jurisdictions and have assets under administration exceeding 500 billion. We are delighted today to be co-hosting this webinar with Ketan Co and KPMG on the interesting developments in the fund space in the India-Singapore corridor and the new Gujarat Finance Tech City. As you may know, while Asia-based asset managers have traditionally used offshore funds, in recent years, Singapore has emerged as one of Asia's preeminent asset management hubs. Indeed, investors have had significant exposure to Singapore investment platforms and structures, especially funds with an Asia-Pacific ASEAN mandate. We firmly believe that this growth is only set to accelerate as domestic fund regimes like variable capital company structure are being introduced, which are designed to compete with global fund structures in other leading jurisdictions across the world. In addition to this, with the emergence of the Gift City as a new destination for domestic and offshore fund managers, the legal, regulatory, and incentive landscape is now front and center for investors. Hence, we will do a deep dive on both jurisdictions, discuss practical considerations, fund formations, licensing, tax structures, and incentives. Our aim is to provide a holistic view of the funds play in India, including the GIFT setup, and in Singapore. In terms of the webinar flow, the session will take the form of a panel discussion, followed by a Q&A. I'm honored to be joined by our experts today, and it is indeed a pleasure to welcome distinguished personalities from Ketan Co and KPMG. We have with us today Vivek Vemani, Partner Funds Practice, Ketan Co, India; Anulekha Samant, Tax Partner, Asset Management in KPMG, Singapore; and Kalpesh Desai, Partner, Deal Advisory, M&A Tax and Private Equity Tax, KPMG, India. Vivek is a partner in the Investment Funds Practice Group in Ketan & Co. He has vast experience in the fund space, advising on a large number of transactions and handholding several offshore fund managers on their India foray and India fund managers on their global expansion. He also has the distinction of setting up the first SEBI-registered India-based hedge fund and obtaining the first InvIT and REIT registrations in the country. Anu has over 20 years of tax experience working in Singapore, Switzerland, and India, out of which 14 years can be attributed to Singapore. She has special focus on fund management sector and has served a wide portfolio of clients comprising mostly multinationals. She has been involved in advising a number of fund managers on tax efficient structures for their fund vehicles, investing in variety of investments, especially pan-Asian funds. Kalpesh has over 20 years of post-qualification tax and regulatory experience. He specializes in transaction advisory services from a tax and regulatory perspective, including deal documentation, undertaking tax due diligences. He also specializes in advising private equity fund clients, including sovereign wealth funds, global private equity funds on structuring their funds' carried interest. Finally, in terms of housekeeping, the webinar will last for 1 hour with an additional 15 minutes at the end for a live Q&A session. Just to get started, if you have any questions during the presentation, please type into the question box in your control panel on your right, and I'll be happy to raise them at the time of the Q&A. Without further delay, I now begin the panel discussion with first question to Anulekha. So Anu, can you provide a brief overview of Singapore as a jurisdiction?
Sure. Yeah. Thanks, Sukanya, and hello, everyone. I'm very happy to be here on this panel. So I think I'm going to spend maybe the next 5 minutes, taking you through what is the, the fund management as well as the fund regime. I'm hoping to see some slides on. Maybe we just give this a minute. Okay, great. If you could move to the next slide, please. Okay, so in this slide, the next couple of slides, what I want to do is just give the audience a overview in terms of the regulatory regime, because I think before we talk about funds, I think it's important to know that you need a fund management entity in Singapore. And depending on the strategy that you're investing in. So the reason I say strategy is because if you're a real estate fund manager, you could potentially be exempted from licensing, but basically other strategies require some level of licensing. So in terms of the various types of license, we have actually four categories. We've got the RFMC, Registered Fund Management Company. We have LFMC, we have the Retail LFMC, and we have VCFM. I think, yeah, a lot of acronyms, Sukanya, but I think the next slide will basically take you to the details. But before I move on, I think what the audience needs to be aware is in terms of actually getting these licenses, I think the expectation from the Monetary Authority of Singapore is that you should at least have, a dedicated and secure office space. You require key managers with relevant experience or record of competency. And I think there's a fair amount of paperwork that needs to be done. I guess it's not too heavy, but there is paperwork to be done for the regulatory license process. If I move on to the next slide, a lot of content, but I think what I just want to do is probably just spend a few minutes just highlighting what are the key parts. So I think what we've done is we've split it into four categories. I think what won't be relevant is maybe the retail license. So I'm not going to touch upon that because we're probably focused on raising money from accredited investors. So in that case, if you are basically just focused on venture cap, we've got a special licensing called the VCFM. It's actually a fairly light in terms of conditions, and I think we've seen a lot of uptake for the VCFM license. In that, and under that, what you require is basically just 2 full-time Singapore-based employees. There isn't any restriction on the number of investors or the AUM. But in terms of who you can raise money, you can only raise money from accredited and institutional investors. If you're looking at other strategies, I think the most popular one that people look at are the RFMC, which in that case you require 2 full-time based employees. You don't really need a compliance officer, but the restriction is that you can only manage up to 250 million Sing dollars in AUM. If you don't need that restriction, you can basically go in for the LFMC, which is focused on accredited investors. That doesn't have a limit in the terms of AUM. Just very briefly in terms of timing, if you're looking for VCMF, I think we've got situations where you are able to get a license within a couple of months. RFMC somewhere between 3 to 4, LFMC for accredited investors, I think sometimes goes beyond 6 months, right? If I had to then move on with this overview with the fund management, I think my next slide talks about fund vehicles itself. I think I'll give my friend a couple of minutes to move to the next slide. Great, thank you for that. So in terms of traditional fund vehicles, we have the unit trust, we have company, which is a private limited company, and there's the partnership. There's obviously the variable capital company, VCC, which I will talk about in a minute. These are traditionally the 3 types of fund vehicles. I would say unit trust, maybe for India focused funds, not so relevant. We use it for other types of investments. So traditionally, for Singapore funds focused on India, it's usually the company or the partnership. So the limited partnership is quite similar to, the Cayman Limited Partnership. I believe, Sukanya, we would be sharing the slides post this discussion, right?
Yes.
Right. So I think instead of taking you through every single thing, I think you will have access to these slides. So yeah, please feel free to go through it. But what I really want to do is maybe spend time a little bit on the VCC, because that, of course, is a good fund vehicle as far as India is concerned. So if we can move to the next one. Great, thank you. So the variable capital company was introduced January of 2020. In terms of what exactly is this variable capital company, I think for the audience that's familiar with Cayman, it's like the Cayman SPC, or basically like the Mauritius segregated portfolio company. So this is what the VCC is all about. What's interesting about the VCC is it's a corporate structure. You can set it up as a standalone, or you can basically set it up as a sub fund where you have an umbrella fund and you have various other sub funds underneath. The VCC, of course, is very much better than the private limited company because you can easily cash distribute. You don't require accounting reserves in order to distribute dividend. And the other part is also because it's a fund, there's confidentiality as far as investors are concerned. So traditionally, if I looked at the India focused funds that we've done from a tax perspective, and I believe that's something that Kalpesh will also cover little later, is that traditionally it's always a corporate structure that we like because that's the part that can access the tax treaties. But to be honest, I think when you look at in the international scenario, people are obviously, or investors are a lot more familiar with limited partnerships. So which is why I find the VCC a good in between, because it offers the flexibility pretty much to what an LPA can offer. Not all the way, but almost there. But then for tax, it's considered a corporate structure. What's great about the VCC is we've got, I think, at least a couple of hundred now, Sukanya, right? And VCC,
yes, absolutely.
right? And what's interesting is it comes with a MAS grant as well. So if you set up a VCC, up to 70% of its setup costs will be funded by the government, capped at 150,000. So that tends to be quite attractive as far as managers are concerned. So with this backdrop, if I can just maybe move on to the next slide. So I guess then Sukanya, with me covering the fund manager, the fact that they have a license, the various fund structures. What I've done in this last couple of slides is to basically give the audience a sense of what is the typical fund structure. So if you look like a real estate PE fund, before the VCC, it was a Singapore limited partnership with a holding company that we would set up, and then we'd have drop down SPVs, which eventually went into into countries such as India or Australia, etc. That's how we would drop it down. And I think you have the intermediate SPV so that you could do an offshore transfer. So this is how a typical real estate or private equity fund would look. And you can replace that entire two entities, the Singapore LP and the holding company, with a VCC. On the next slide. So this is in a situation where we had the hedge fund. So before the advent of the VCC, we used to have a Cayman SPC because it's an open-ended structure. And unfortunately, we didn't have an equivalent in Singapore. So a lot of our hedge fund managers with India focus as well would set up a Cayman SPC. Now we're seeing them doing a VCC. So that's how that would work as far as a hedge fund is concerned. I think the next slide, if memory doesn't fail me, is probably credit. So credit funds. Credit funds, again, yeah, similar to private equity real estate, but because we have facilities, there isn't a need for drop down SPVs. This is how we would structure it, or we would do it as a VCC. And the last one being venture cap on the next slide. Right, something similar to credit again, because of ticket size, doesn't make sense to have too many SPVs. Again, can be you can have just basically a single VCC, and some of our clients that do venture cap are actually looking at the VCC as opposed to the sandwich structure. Good, so that's my elevator pitch, Sukanya. So back to you.
Thank you, Anu. And I think this was quite insightful. And I'm sure that, with this backdrop, we will definitely see, and we have, in fact, in the last 1 year, seen a lot of interest on the VCC. And I'm sure that the audience must have found this very interesting as well. So now moving to Vivek. Vivek, could you briefly describe an overview of the AIF regime in India?
Sure. Thank you, Sukanya. Good morning, friends, and thank you for your time, taking out the time to participate in this webinar. So in this webinar, like Anulekha just covered Singapore, our intention was to give you a brief overview of Singapore versus GIFT, which is the upcoming jurisdiction in terms of fund formation and investment fund. So the basic question which comes to our mind is, what is GIFT essentially? So the GIFT City is essentially a financial services SEZ, which is located in Gandhinagar, India. So any sort of financial services activity that you want to do, GIFT would be your jurisdiction, not only for within Indian investments, but if you want to do banking or insurance businesses, that is something globally, if you want to do that, GIFT would be your jurisdiction preference to that extent. So I'll quickly take you through some of the regulatory update which has been formulated by GIFT in the recent past to promote GIFT as a jurisdiction before I move on to the investment fund regime in GIFT. So basically in GIFT, they have formulated the operational guidelines for PMS, that is portfolio managers and investment advisors. And they're also coming up with new 9A rules, which will facilitate fund management or basically segregated portfolio management out of the GIFT city. So in terms, you can directly provide portfolio management services or advisory services without having to worry about OEM and PE exposure for your clients out of GIFT City. They've also, in order to promote trading out of GIFT City, what they have introduced is they have introduced rupee derivative, bullion derivatives, and a whole host of derivatives out of the GIFT exchanges. REITs and InvITs, which has become a popular product in India, they've also, in order to facilitate their trading outside the Indian stock exchanges, they have permitted REITs and InvITs to also be listed in the GIFT City exchanges. In terms of the fund formation regime, they have while it's an adaptation of the AIF regime, they've also provided flexibility to make GIFT globally a competitive jurisdiction to that extent. And in terms of participation, while all non-resident investors were allowed to participate in GIFT City, the RBI has permitted flexibility for even Indian residents now to invest in GIFT AIFs. So if you have global investments and global investment themes out of GIFT, you can look at tapping for the LRS money to that extent. And recently, in the last 1 or 2 days, there's been a new development. So GIFT has also proposed to come up with a VCC regime for fund formation. So in terms of choice of vehicles, they are exploring the VCC concept, which is globally popular. So I'll move on to the next slide, which is essentially setting up of an AIF or an investment vehicle in GIFT. So like I mentioned to you before, the current framework is an adaptation or it's been adopted or primarily formulated around the existing AIF regulations. So to that extent, the domestic AIF regulations and the GIFT City AIF regulations are similar. However, of late, the GIFT authorities, that is the IFSC authority, has provided certain relaxations in terms of certain basic criterias in terms of what are the investment limits, what is the level of borrowing, the investments basically can be done outside of India without limitation. So there have been certain modifications made to the current framework of the AIF regulations to make it more acceptable to global investors. While I mentioned to you it's an adaptation of the existing AIF regulations, so the choice of vehicles which are available in the GIFT City are similar to those available for onshore AIFs, which are trusts, LLPs, and companies. With VCC being a new addition, we are still waiting for the regulations to come out. Then in terms of the regulations, it is basically aligned to the AIF regulations itself. Can we move to the next slide, please? So the basic regulatory framework, as mentioned, continues to remain the same between GIFT and the domestic AIF. So while most local AIF managers would be familiar with this, the numbers have been basically converted into USD. So if you look at the minimum corpus size, etc., required for an AIF, it's $3 million, which is roughly, if it translated, it's almost a 20-21 crore limit. So the limits per se continue to remain the same. And in terms of the continuing interest, which is the minimum skin in the game, which is required to be had, continue to be the 2.5% or the equivalent of 5 CR, which is approximately 750,000 for category 1 and 2, and basically 1.5 million for category 3. Now, in terms of the gift regime, the choice of your AIF still continue to remain the same. So it depends on your strategy per se, where you have the category 1, category 2, and category 3, which are listed on your screen. So category 1 is essentially if you have a venture capital sort of investment strategy, or specifically an infrastructure strategy, then you can opt for the category 1 category. And if you want to do anything which is predominantly in the unlisted space, but you don't want to be sort of caught within the framework of the venture capital regime or the infrastructure regime, which is prescribed under category 1, then you can look at the category 2 AIF. So the category 2 AIF, as you would be aware, has been very popular with private equity clients for your credit funds and for even for your debt and similar funds. The category 3 is the hedge fund category. So in case you want to register, you want to basically manage a hedge fund, then you have to look at a category 3 registration, which permits you to basically trade and deal in listed securities and complex strategies to that extent. Next is, I think I will quickly, while the audience would be familiar with the AIF regime, I will quickly take you through what are the key dispensations which the IFSA authority has made for gift-based AIFs to that extent. So in terms of, sorry, you can go back to the previous slide. So in terms of the key differentiations between both the regimes are essentially the regulations continue to remain the same. What is interesting to note is that in terms of permissible securities, the GIFT AIF is permitted to invest in all securities which are there listed in the GIFT exchange, which is issued by companies based out of GIFT. You can invest into Indian companies without any limitation. Your investments will be under either of the regimes, which is FDI, FECI, or as an FPI. That would predominantly apply to category 3. You can invest in units of other AIFs. So a gift AIF may be structured as a fund of fund or a feeder vehicle, which is the typical option which a lot of clients are exploring. And you can invest into India-based AIFs. And in addition to that, gift AIFs are also permitted without any limitation to invest in overseas securities. Otherwise, your normal onshore AIF has a limitation that they cannot invest more than 25% of their investable funds in a single in aggregate basis in offshore securities. So that limitation has been dispensed away with. So essentially, with this limitation being dispensed away with, if you are looking at a global fund or a regional fund to invest in Southeast Asia or even the ASEAN or the SAARC region, you can consider a gift AIF for that extent. So it to that extent, it competes with the likes of Cayman, Mauritius, and Singapore, given the flexibility. And in terms of the bank account for your gift AIF, you can retain the bank account in US dollars. So all your monies will be kept in USD and you don't need to convert it into INR to that extent. The other flexibility which the IFSA has provided is in terms of borrowing, there are no limitations to the amount of borrowings you want to do. When you look at the domestic AIF regime, there is a limit on borrowing, saying Cat 1 and Cat 2 can't borrow more than 10%, and Cat 3 has a leverage limit of 2x of its investable leverage limit of 2x of its NAV. So to that extent, the gift AIF is free to borrow and the borrowing or the leverage limits is determined based on your PPM and your fund documents to that extent. Similarly, in terms of investment limits, the GIFT AIF doesn't have investment limits. So even if you want to structure a fund for just one investment, the GIFT AIF regime provides you with that flexibility to do so. And also in terms of co-investment as a strategy, if you want to provide it within the same vehicle, that is also something which the GIFT AIF has provided the flexibility that you can structure special classes within the GIFT AIF to provide this flexibility to investors. Can we move to the next slide? Similar to the AIF regime, I think the minimum investment limit for investors continues to remain the same, which is at $150,000, approximately 1 crore rupees for any investor. And for employees and managers, it is basically limited to 25 lakhs, or the equivalent is almost 40,000 US dollars to that extent. Now, I think we can move to the next slide. We give the audience would be familiar with the AIF setup. So typically, I think we'll just go through the brief structure of a GIFT structure. Where we have the GIFT AIF, like I mentioned to you, it can be structured as a trust, company, or a limited partnership. While trust is the popular vehicle for onshore AIFs, in case of GIFTs, trust remains to be popular. However, given the investor familiarity with the LPGP structure, we are seeing investors prefer a limited partnership structure. So you do have LP structures also in predominantly the partnership structures being set up in GIFT. Like the AIF structure, the AIF is the vehicle which needs to be registered in case of GIFT. So the registration is provided to the pooling structure as compared to Singapore, where your manager gets it. But in case of AIF, it is the pooling vehicle which receives the registration. For your AIF, also what you require is an investment manager and a sponsor. So the manager is responsible for management of the AIF, and in terms of entity-wise, you also need a structure. So the manager can double up as a sponsor, or you can also have a sponsor separately set up to that extent. So that option is all available with you. Can we move to the next slide? So I think we can move to the next slide. This is pretty much covered. So I think we'll cover this a bit later. We'll move to the next slide. Next slide, please. Yeah. So I'll quickly take you through the considerations for setting up a manager and a GIFT structure. So while most of us will be familiar with an AIF structure onshore and you would have your relevant entities in place, however, GIFT is a deemed foreign territory for Indian foreign exchange purposes. So in terms of a manager setup in GIFT, what is permitted by the regulations is that you can either set up the manager as an existing as a branch of an existing AIF. So if any of your group entities have an AIF or act as AIF managers, you can set up a GIFT vehicle. You can set up a GIFT manager as a branch of the existing AIF manager. Else you can set it up as a wholly owned subsidiary of your setup, for which purpose you will have to comply with the ODI regulations and fulfill all the conditions which are mentioned there. So this would essentially require that if you set it up as a subsidiary, you would have to go to RBI or SEBI, as the case may be, and take necessary approvals to set up the entity to that extent. In terms of the sponsor vehicle, the manager itself, if it's a separate subsidiary, you can act as the sponsor itself, or else an Indian entity can act as the sponsor and fund the sponsor commitment of 2.5% or $750,000 out of its own books of accounts, and that is a permitted foreign exchange transaction. Or else you can even take an RBI approval to set up a sponsor entity in GIFT and sort of get it registered as a GIFT. vehicle to that extent. Separately, I think what slide I sort of skipped over was in order to promote GIFT as a jurisdiction for all funds, whether new or existing, the GIFT authorities have come up with a relocation or a migration scheme. So to that extent, if you have any existing funds which are based out of India, based outside India, and you want to migrate it into India or use the GIFT structure on account of its favorabilities to that extent, you can sort of migrate your structures from the relevant jurisdictions, say Cayman, Mauritius, Singapore, or any other jurisdiction to GIFT. And that movement is a tax neutral transaction to that extent. And as consideration for the migration, your investors can get issued the unit or the units of the gifts or the shares of the gift AIF to that extent. Kalpesh would be covering the taxation of this. Basically, he would be taking it in further detail. Next slide. Next slide, sorry. Yeah, so this, I think, Sukanya, over to you.
Okay. Thanks, Vivek, and thank you for giving a deep dive on the regulatory landscape of GIFT. And certainly, it's very interesting, and this is an emerging jurisdiction for fund location. So interesting for all of us. So now that we've understood the regulatory aspect, it's good to understand what are the tax incentives available. So Kalpesh, moving to you, what is the tax incentive available for managers in domiciling their funds in GIFT?
Hi everyone. Good morning to participants from India and good afternoon to participants from Singapore. Thank you very much, Aif and Ketan, for having me on this call. If we can move to slide 24, I believe that is where we have populated the tax incentives that are available. And I've tried to draw a comparison between a fund setup, let's say in Singapore, versus a fund setup in GIFT City. Largely, the funds are expected to earn income in the nature of either interest, dividends, or capital gains. And the taxation in India depends on basically the residential status of the investor, the nature of the income, and the incentive scheme that may be available to a particular investment. As we probably many of the participants on this call know, Singapore tax treaty is a far more favorable tax treaty, and many of the funds therefore have sought to participate from Singapore into Indian investments. Apart from the favorable fund regime, it also gave a lot of tax incentives. To that extent, Singaporean funds have been holding investments and earning income in the nature of, let's say, dividends, interest, capital gains on sale of equity shares in Indian companies, capital gain on sale of other securities issued by Indian entities. And they may also have been holding shares in securities of other companies which might have benefits or value derived from Indian securities in India or Indian assets, so to say, subject to indirect transfer tax. As far as the Singapore Treaty is concerned, if the Singaporean entity is eligible for the treaty, subject to the multilateral instrument, principal purpose test, and general anti-avoidance rules conditions being satisfied, then capital gain on sale of shares to the extent the investment was made prior to 31st of March 2017 is no longer liable. It's not liable to tax in India. However, if the investment was made after 31st of March 2017, such investments and gain on such investments is liable to tax in India. So say capital gain arising on sale of shares in an Indian company acquired post 31st of March 2017 will be taxable as if it's a non-resident selling the shares. Long-term gains, that is after holding the shares for at least 2 years or 1 year in case of listed, will be taxed at about 10% plus surcharge and cess. Whereas short-term gain in case of listed will be at about 15%, in case of unlisted it will be about 40%. Interest, if any, earned by a Singaporean entity subject to it qualifying for the treaty benefit and being beneficial owner of the interest income, which is a subjective test, and it needs to be established that the recipient of the interest income is actually indeed the beneficial owner of the interest income. Then under the treaty, that rate can be brought down to 15%. In certain situations, it can be brought down to less than 15% based on the Indian domestic law principles. Dividend income, on the other hand, is taxable at the rate of 10% to the extent the shareholder, the Singapore fund, is owning more than 25% shares in the Indian company. Otherwise, it is taxed at 15%. So this is the overall gamut of the tax liability for a Singapore fund. On the other hand, if we look at the gift established funds, there could be, as Vivek mentioned, for different strategies, different funds that can give rise to different types of income, different nature of income for different funds. And for Cat 1 and Cat 2 funds, we have a tax incentive scheme where we treat these funds as pass-through funds, and we don't tax the funds themselves, we tax the investors in these funds. Assuming that the Cat 1 fund and Cat 2 fund earn income in the nature of capital gains, interest, and dividends, somewhat similar to a Singapore fund will earn, the Cat 1 fund or Cat 2 fund will not be liable to pay any tax. Instead, the investors in the Cat 1 fund and Cat 2 fund will be liable to pay tax. Now, with a view to give further incentive and give a little bit more comfort to the investors, the Indian revenue authorities have provided for an exemption to the investors in these Cat 1 funds and Cat 2 funds from obtaining any Indian tax registration and making any tax filings and undertaking any compliances, so long as their income is only from these investments. And the funds, when they distribute the income, they are undertaking appropriate withholding of taxes. So if an interest is paid out to a fund investor coming from Singapore, more or less the same outcome can be achieved as if it was investing from Singapore. Dividend income could have somewhat similar outcome, and capital gains will also have somewhat similar outcome as if they have invested from Singapore. There has been some debate which has been going on availability of treaty benefit when interest and dividend income are passed through from a Cat 1 fund and Cat 2 fund, but industry as a whole has taken a position that such benefits should still be available. As far as Cat 3 funds are concerned, Cat 3 funds have a little bit of a different a possibility of different type of income character. They may earn income which may qualify as capital gains. They may earn income which may qualify as business income. Now, to the extent the income qualifies as business income, the gift laws provide for a tax exemption for a period of 10 years out of the block of first 15 years. As far as capital gain is concerned, again, there is a possibility of claiming a tax exemption to the extent the capital gain arises from sale of securities other than shares. To the extent the gain is arising on sale of shares, that is taxable. So that's as far as the incentive for the funds go. The management entities that are established in Gift City also enjoy this business income exemption. So out of first 15 years, for block of 10 years, the managers can avail for tax exemption in respect of their income. And because the gift is qualifying as a special economic zone, the services rendered by the manager to the fund is not liable to GST. That's an additional advantage that comes along as compared to setting up a fund in the domestic tariff area in India. Vivek mentioned and slightly touched upon the rules in relation to migration of existing funds which are currently situated in a jurisdiction outside of India to a Gift City fund. Migration is a new incentive that has been prescribed with a view to incentivize existing fund managers to migrate their funds from a non-India jurisdiction to Indian jurisdiction, where the migration and subsequent sale and income arising on subsequent sale could be held to be tax exempt on the basis that existing fund itself was eligible for tax exemption by holding those investments. So both the actions, the migration and the subsequent sale, could be tax exempt. There is a concern that the investors might then end up paying tax to the extent the distributions get made by the Cat 1, Cat 2 funds. But for the purpose of migrated funds, there is that exemption also, which has been extended to the investors. So on an overall basis, the gift incentives are in a way reasonably well outlined and well enshrined. We can avail of those incentives without having to prove the necessity of locating ourselves in a geography other than so we don't need to necessarily rely on a treaty benefit. Therefore, we don't need to establish why the fund was established in Gift City versus, let's say, if we were to establish in Singapore. So principal purpose test and general anti-avoidance rules may become a little bit easier for us to establish and fulfill those conditions to the extent the funds are established in GIFT City. However, this is a new concept and it needs to be seen in terms of how it goes over a period of time and whether we achieve the outcome in practice as well in the assessments. So Kanya, over to you if you want to take the next.
Thanks, Kalpesh. And I think this was indeed a very good overview for tax implications for funds both domiciled in Singapore and GIFT. So now over to Anu. Anu, what are the tax incentives available to the fund and the fund managers while domiciling in Singapore?
Sure. Thanks, Sukanya. So I think maybe if we could move to the next slide. So in terms of fund tax incentives, I think the reason why we have this is also to ensure that whatever income streams come into Singapore, it's tax neutral. So of course, Kalpesh has taken us through in terms of the Indian tax implications. So the idea here is once that funds come to Singapore, it shouldn't be taxed. So in the question is how do you get to that? Basically on this slide, there are these list of Singapore fund tax incentive schemes that a manager could potentially choose from. The 13R and 13X are something which are a lot more popular. 13H is something new which they have basically brought forward for especially for venture capital funds. And the reason being that if you have an incentive such as 13X, you require $50 million fund size, whereas 13H, they are obviously cognizant that VC funds don't necessarily have such a big capital to start with. I mean, a standard VC fund could be like anywhere between 20 million, and then if you're probably at your second or third fund, it's 50 to 100. So they've kind of tried to streamline this for VC funds. So again, for the audience, lots of details. So please, you can read it in your own time. And, if you have any questions, you can come back to us. I'm also cognizant, Sukanya, that, we have only 20 minutes. I'm just going to move to the next slide very quickly. Thank you. Okay, so since we've been talking a lot about Singapore funds, we shouldn't forget about fund managers. They work very hard. They make a lot of fees. And so, well, not a lot of fees, they make fees. And so we just have to make sure that, they pay some taxes. So in terms of the corporate tax rate for fund managers, I would say just corporate tax rate is 17%, but there's a possibility to bring that percentage down from 17 to 10. And for that, you require 3 investment professionals. You need to be managing at least 250 million Sing dollars. So that's a possibility. There's also a very attractive 5% concessionary tax rate, again, available only for venture capital fund managers. It's basically, obviously, in terms of Singapore, there's the new focus. And so you could get a 5%. If you see my little box over there in the blue, which is very small, and I'm not sure why, and it says carried interest. I think what's interesting is when we are talking about tax rates, you could actually structure your carry tax-free, as in most Singapore taxes. So, and I won't tell you how, and so maybe that's basically a different discussion. But in terms of management fees, that is basically where we look to have tax leakage. So I think, Kanya, that's basically all from me. Yeah, just in a nutshell in terms of the tax incentives.
That's great, and thanks, Anu, for giving us a deep dive and a brief deep dive rather on the tax incentives available for both fund and the fund managers. I think now the second important question that we get from and we need to consider is more from substance point of view. So if Kalpesh and Anu, both of you, could let us know what are the considerations for substance from an India perspective, and Anu, for you, could you supplement for demonstrating substance in Singapore?
Kalpesh, you want to go first?
Sure. Can we move to the next slide where I have tried to populate some of the reasons why it is important to have substance? So as far as India is concerned, India wants to, just like any other global tax jurisdiction, India wants to make sure that it is looking at not only the form of the entity and form of the vehicle which has been earning the income, trying to avail of the incentives which are made available either under the treaty or under the domestic law. It wants to look at the substance. It wants to make sure that we have adequate on feet, on ground substance which is available where the tax office feels satisfied and then will grant the benefits. Why is it important to have substance, for example, for a Singapore entity which is likely to just have, let's say, capital gains or likely to earn interest income or just like dividend income? There are two or three key reasons why substance is very important. One, it is very important for an offshore fund to qualify as a non-resident Indian from a tax perspective. If you don't have substance and if you are managed, let's say, or if you appear to be managed from India, in which case you might have a place of effective management in India, which can then create more complications in terms of compliance and tax liabilities associated with it. So if you want to avail the tax treaty benefit rates in terms of the, let's say, interest income at 15%, dividend at 10 and 15%, you want to avail the rate of tax on capital gains at 10%, not be liable to tax on indirect transfers and sale of securities other than shares, you must satisfy the substance. Likewise, for availing the big gift city benefits, you should have an adequate substance on ground. Substance typically will mean that you are complying with the local regulatory registrations. You have all the necessary registrations and licenses to operate there. You have appropriate local presence in terms of the office, administration, infrastructure. You have adequate number of people who are qualified and who have adequate experience to support the kind of activity that you want to undertake. You should have local expenses incurred in the geography wherever you are established and you claim to have substance there. And you need to have you need to maintain local records like books of account, bank accounts, administrators, and if you have additional, let's say, third-party service providers or joint venture partners, that is then going to add to your substance. So as much as possible, substance is needed in either Singapore or in India, wherever you establish. While the regulators require their own minimum substance to be fulfilled, but you must have on top of that whatever is necessary to prove that you actually operate from that geography. Back to you, Sukanya.
Sure. So Anu, just wanted to check if, in case you had any additional points to make from a Singapore perspective.
No, I think if we did all this, what Kalpesh said, I think we'd be very happy, right? Because
Great.
because this definitely looks like a gold standard as far as I'm concerned.
No, that's great. That's great. And I think this now, I think we kind of have a well-rounded view, and as far as both jurisdictions are concerned. So, to Vivek, I would like to ask this question. So, what are the prerequisites for setting up in GIFT City, and what is the time frame to be kept in mind for regulatory approval?
Sure. So, Sukanya, I think, and the audience, when we look at setting up the GIFT City structure, the AIF, what we have to remember is that in addition to, given that GIFT City is a fairly new jurisdiction, you have to set up the pooling vehicle as well as you have to set up the investment manager entity. So when you are looking at the investment manager entity, what I mentioned to you is that you can either set it up as a branch or as a subsidiary. In case if it is a subsidiary, then requisite RBI approvals need to be taken. Once those approvals are taken, you would have to sort of approach the GIFT City authority. So basically, once the RBI approval is taken, you can do it simultaneously. What you can also do is apply within the GIFT City to take basically have your company or the LLP incorporated. So your manager in GIFT City can be set up in the form of a limited liability partnership or as a company. So that can be a simultaneous process which you can do. For example, you have to do the name reservation first. There is an allotment of unit because both your fund as well as the investment manager have to be units within an SEZ to get the benefits of the SEZ exemptions, which sort of Kalpesh just mentioned in terms of taxation of the SEZ unit, which is the manager is exempt from tax and GST. In order to get that, you have to comply with those. Once you have your entities formed per se, either it's a trust for your pooling vehicle or a manager being an LLP or the company, then you have to, as a next step, you have to go to the SEZ authority and get your registration for both the vehicles, the manager as well as the AIF, as an SEZ unit. So that is a separate registration which you have to take. Once you have that registration in place, then you have to apply to the IFSA authority and get the AIF registration. So like I mentioned, in India, as compared to Singapore, the fund vehicle is regulated and not the manager. However, from an eligibility conditions, the eligibility conditions have to be fulfilled by the manager, and it is on basis of the manager's infrastructure and eligibility norms getting fulfilled that the AIF is given registration. So a manager is deemed regulated, but however, there's no formal registration certificate. So in terms of infrastructure, what you need to ensure is that, like Kalpesh also mentioned, you need a tax infrastructure in place. But from a regulatory perspective, also you need to have adequate office space, infrastructure, employees in place. So currently under the regulation, you need at least one employee with 5 years experience in the fund management space and a professional qualification basically in the finance space to basically run the AIF. Now, when we come to time period for all of this, yes, it does look long, but however, it's a fairly streamlined process where the IFSA authorities will guide you through the process. So what we are essentially looking at in terms of months is more like 3 to 4 months, or basically 14 to 18 weeks approximately is what is the time period which we can look at. And once your application reaches the IFSA, it's like a streamlined process, and it's they are the unified or the nodal regulatory authorities to give you the license. Just to bear in mind, if you are a category 3 AIF, there is an additional registration which you have to take, given that you will be investing under the FPI regime. So there will be an additional FPI registration which the AIF would need to take. Thank you. Sukanya?
Sure. Thanks. So this brings us to the end of the, this discussion. And now we move on to the Q&A session. And, while we are waiting for, our audience to type in the questions, we have already few questions that we received during the registration. So Vivek, I would first like to ask you the question that we received from Pradyumna Dalmia, Managing Partner, Triton Investment Advisors. His question is Singapore versus GIFT, pros, cons, and costs.
Okay, so when we look at Singapore versus GIFT, pros and cons, I think when we look at both the jurisdictions, I think the purpose of this webinar was to give you an insight of Singapore and GIFT when it comes to structure to that extent. Both of the jurisdictions, if you look at it, or are basically FATF registered and have basically regulators who are globally renowned. Now, when it comes to jurisdiction selection, it is primarily driven by your LP preferences. However, some of the key considerations when you have to look at a jurisdiction of choice is the choice of vehicle available in those jurisdictions. So when we look at choice of vehicles and you compare Singapore and Mauritius, Singapore and GIFT, both of them are similar. You have trust, company, and LLP to that extent in both the jurisdiction, and also GIFT is coming up with the VCC structure. So I would tag them as equivalent in that sense. In terms of costs, Singapore, as we are aware, is a slightly more expensive jurisdiction as it when it would be compared to GIFT. So GIFT would be given that it's an it's an India-based setup. You will have cost efficiencies to that extent. So there would be some cost savings when it goes to GIFT. And further, the tax benefits which are sort of provided by the government in terms of GST and basically in both the jurisdictions. So to that extent, they would be similar, but operational costs may be slightly cheaper in GIFT as compared to Singapore. And in terms of basically the other important criteria would be choice of basically the tax structuring which is available. The tax structure locally in terms of Singapore is that when you are investing outside Singapore, you will be subject to that tax. So that local tax will be there. The key difference between what I can understand is between both the structures is that in case of a gift structure, category 1 and category 2 are looked through. So the investors sort of in their local jurisdiction can claim sort of credit for the taxes paid in India if that regime is available. For example, it's there for US investors. However, in Singapore, any taxes which you pay out of an investment in India may be a cost, but otherwise distribution per se is neutral. I'll primarily speak about gift in terms of what are the benefits of gifts that we predominantly see. In terms for a local GP, when you look at gift versus Singapore, location advantage is definitely something big, which when it comes to gift and familiarity with the regime. So most of your local GPs would already be operating the AIF regime. So to that extent, you are familiar with the AIF laws, and the gift laws are an adaptation of the AIF laws. So to that extent, there is familiarity already. Creation of substance may be easier in gift in terms of if you have to send certain resources to Gujarat, that may be possible. Um, then cost advantage, I have already sort of provided you an overview of what it is. And the additional flexibility in case of a gift structure is that you can freely market a gift structure to Indian residents. So if you want to sort of set up a global fund, you can also raise LRS funds in addition to offshore funds, which when it comes to sort of a Singapore structure, there may be certain limitations as I can see it. Otherwise, I mean, between both the structures, GIFT is upcoming as a jurisdiction. And from a perception perspective, Singapore is well settled and it's a well established jurisdiction, and global investors have comfort. But with GIFT, we have a few big players who have moved to GIFT, and the familiarity is coming. And what we've seen over the last 2 months is that a lot of Indian GPs are making a beeline or moving to GIFT to set up their feeder structures to that extent.
Thanks, Vivek. Vivek, our next question is also to you. So this question is from Subrat Utkata, Senior VP, IDB Trusteeship. Are the current provisions of the government adequate enough to attract many more AIFs other than domestic ones like Zerodha? What is more on the cards?
So I think it is interesting to see that currently, at least the domestic players have shown their confidence in the gift structure. So it's only a matter of time. See, I mean, till last year, you were still questioning whether whether this regime is even workable or not. However, the government has made favorable changes as the industry had demanded. For example, if you look at the tax changes for foreign investors, they have done away with the requirement for tax filings and PAN, which is a relief for the investors per se, that they are not subject to tax compliance merely for investing in a gift structure. Then in terms of regulatory regime, they have eased the investment limits, etc., for gift structures and made it more globally competitive. So I would say it's only a matter of time that we will soon see Southeast, at least the regional funds, also looking at GIFT definitely. And given the regulator and India being an FATF compliant jurisdiction, the move should come soon. So I'm very hopeful for GIFT as a jurisdiction.
Thanks, Vivek. Vivek, I know you briefly mentioned this in your previous answer, but there is this question we have received from Sambit Bangaraj. Can an offshore fund managing purely offshore assets like bonds, equities, etc., register in GIFT and have resident Indians through LRS invest in such strategies like a feeder vehicle?
Yes, so to that extent, yes, you can set up a vehicle in GIFT which can invest both in GIFT securities, Indian securities, as well as overseas securities. So a GIFT vehicle is permitted to invest 100% overseas, and you can freely raise money from. Basically, if your strategy is purely to invest outside India, then you can raise money under the LRS route from resident Indian to that extent.
Okay, thank you. The next question is for one of you, Vivek or Kalpesh. This is what could be potential challenges for international investors to invest into a gift fund?
Do you want to go first?
Kalpesh, I think you can take the tax challenges if you see any, and I can probably look at the legal challenges post that.
Sure, sure. So in fact, there has been a lot of you know apprehension that the investors were expressing that investing in a gift fund, which is basically going to be a domestic Indian fund, will mandate the investors to obtain a tax registration with the Indian authorities and then make tax filings with the Indian authorities. With the amendments that have been made recently, the investors, to the extent they have income only from the gift fund and nowhere else, they are exempted from taking Indian tax registrations as well as from making any filings vis-a-vis the Indian tax income that they might have generated from these funds, so long as there has been appropriate withholding which has been made. So to that extent, the apprehensions that have been expressed have been allayed. There has been another challenge that the investors who were looking to invest in India who were facing some of the challenges were that if a distribution is made by an AIF, a withholding has been made, and the offshore vehicle which has invested in the gift city is, let's say, a pooling vehicle outside of India, and that pooling vehicle makes further distributions to the investors, would that trigger any indirect transfer tax? Again, the tax authorities have clarified that that will not trigger indirect transfer tax, and therefore they will not be subjected to any further reporting or any further taxation in India. So to that extent, the Indian government has been making right noises and right changes to facilitate these investments. In fact, I just want to add one more point. Let's say if a non-Indian fund was to make investment and was to look to exit, there is generally a debate that we get into at the time of exit with the buyers on whether withholding is applicable, if applicable at what rate, and then we get into indemnity discussions and for how long, and all those discussions typically come in, which takes a lot of time. Where a gift AIF is selling the shares, it's a resident Indian selling the shares, there is no withholding applicable. And therefore, it can actually avoid a lot of discussion around what withholding, if at all withholding is applicable, or period for what, period for the indemnity, and all those arguments can be avoided. So it can be a good outcome for the investors and the fund managers if they were to actually relocate themselves in gift. Vivek, do you want to come in?
Sure, Kalpesh. No, I would agree with what you just mentioned. So from a tax perspective, at least all the right changes have been made. And from a legal perspective, I think if when we look at the gift structure, they have provided a fair bit of flexibility. And per se, what I have at least seen in my experience is that the foreign investors are pretty much over the last couple of years have got comfortable directly investing into an Indian fund structure. And if you look at it, the Indian fund structures are well-regulated structures. And also to that extent, if we have to look at the governance regime for any of these funds, would match any of the other sort of global structures available anywhere across the jurisdiction. So from a legal perspective, I don't see any concerns per se which investors could have whether it comes to onshore AIFs or even the gift AIF structure.
Thanks, Vivek, and thanks, Vivek, and thanks, Kalpesh, for giving us this in-depth answer to this question. So, Anu, the next question is for you. What has been the response to the new VCC regime, and how has it fared in comparison to other fund structures?
Sure. Okay, so I think as Kanya had mentioned that the VCC was introduced January of last year. I think we're coming to almost close to 200, I think, in terms of VCC. So it has been taken up by a lot of fund managers with different strategies, different geographies. And I think the trend will only go up in terms of the use of the VCC. And I think the other part also in terms of, the VCC, we had obviously our first legislation with all the various features, but there continues to be working groups in order to, refine it even further. So for example, I think I mentioned that, if you want to set up a VCC, that's only possible if you have a licensed fund manager. But if you're a real estate manager, you are not licensed, and so a real estate manager could never set up a VCC. We're actually looking at another enhancement to the VCC regime, which is VCC 2.0, where they're looking up to open it up for real estate managers. They're also looking up to open it up to single family offices, because there's been a lot of focus from family offices to set up in Singapore as well. So the VCC is basically looking at that. So I think, and also what I would say that maybe now we find more of the more established fund managers looking at it as well, because we are now 2 years down, almost 2 years there. It's not necessarily a newbie, and I would see that there'll probably be a lot more. There'll be a lot more interest in the VCC going forward.
Thanks. I think with this, we have reached the end of the webinar. We've already crossed our 1 hour time limit, and we have received actually more questions. And what we can do is, this is the message to the audience, that we will try to answer all the questions and provide them to emails. We have noted the email addresses of the audience members who've asked us these questions. So on behalf of all the panelists, I'd like to thank all of you for giving us time and opportunity to present both the jurisdictions. And please do feel free to reach out to any of us for any further questions or any information. Thank you.
Okay. Thank you. Bye.
Thank you.